What are the disadvantages of floating mortgage rates? Floating mortgage rates pose a significant drawback due to their unpredictable nature. The primary disadvantage stems from the possibility of the interest rate floating upward, causing a subsequent rise in the borrower's monthly payments. This unpredictability makes it challenging for individuals to budget their cash flow effectively, and it hinders the ability to calculate the long-term costs associated with borrowing. One of the key concerns with floating rates is the potential escalation of monthly payments. As the interest rates fluctuate, borrowers may find themselves facing increased financial strain, and in some cases, these elevated payments may become untenable. This uncertainty creates a level of financial instability that borrowers may find disconcerting. The inherent unpredictability of floating rates also extends to the broader economic context. Since these rates are influenced by market conditions, borrowers are susceptible to external economic factors. This lack of control over the interest rate can lead to financial stress and may impact the overall affordability of the mortgage. Another noteworthy disadvantage is the potential for a considerable increase in the overall cost of borrowing. While floating rates may start lower than fixed rates, the cumulative effect of successive increases can lead to a higher total interest payment over the life of the loan. This cost variability can catch borrowers off guard and may impact their financial stability. Why do banks prefer floating rates? Banks favor floating rates as they align with short-term liability exposure. Banks have a preference for offering floating rate loans primarily because these loans allow them to manage their interest rate exposure effectively. The key factor contributing to this preference is the alignment of floating rates with the short-term liabilities that banks often incur. Floating rates are inherently linked to short-term interest rates, providing banks with a level of flexibility in adjusting their lending rates based on prevailing market conditions. This alignment is crucial for banks to ensure that their lending practices remain in sync with their short-term financial obligations. By offering floating rate loans, banks can more effectively manage the interest rate risk associated with their liabilities. Moreover, the cost advantage associated with floating rates is a significant driver for banks. These loans are generally offered at lower initial interest rates compared to fixed-rate loans, making them an attractive option for borrowers. The ability to attract borrowers with competitive interest rates while maintaining flexibility in adjusting rates based on market changes enhances the overall appeal of floating-rate loans for banks. Can I change floating interest to fixed interest? Shifting between floating and fixed interest is possible with considerations. Yes, it is possible to transition from a floating interest rate to a fixed interest rate, and vice versa. However, it's essential to be mindful of certain factors when contemplating such a shift. When switching from a floating to a fixed interest rate or vice versa, borrowers should be aware that a conversion fee may be applicable. This fee is typically a percentage of the loan amount and can range up to 2%. Therefore, individuals considering this transition should factor in the associated cost to make an informed decision. The decision to change from floating to fixed interest rates or vice versa is a significant financial choice. It directly impacts the borrower's equated monthly installments, EMI, and, consequently, their overall budget. Before making this decision, it is advisable for borrowers to carefully evaluate their financial situation, future interest rate expectations, and the potential impact on their monthly cash flow. Opting for a fixed interest rate provides stability in EMI amounts as the interest rate remains constant throughout the loan tenure. This can be advantageous for individuals who prefer a predictable and consistent financial plan. On the other hand, choosing a floating interest rate exposes borrowers to market fluctuations, with the potential for lower or higher EMIs based on prevailing interest rates. Which is better, fixed rate or floating rate? Floating rates are slightly lower. Choose based on interest rate expectations. The decision between a fixed rate and a floating rate mortgage hinges on individual preferences and market expectations. Here's a concise breakdown to aid in making an informed choice. Fixed rate mortgage offers stability with constant interest rates. Ideal for those wanting predictable monthly payments. Suited when prevailing rates are relatively low. Protection against potential future interest rate increases. Floating rate mortgage. Initial rates are slightly lower than fixed rates. Payments can fluctuate based on market conditions. Suited for those comfortable with interest rate variability. May be advantageous if rates are expected to decrease. Ultimately, the choice depends on the borrower's risk tolerance, financial goals, and outlook on interest rate movements. If you seek stability and are content with prevailing rates, a fixed-rate mortgage may be preferable.